Alrighty, I think we'll get started. Good morning, everybody. Welcome to Start Community Foundation's 2022 Investment Update. I'm Carrie Bass, the CFO for Start Community Foundation. It's my sincere pleasure to once again introduce Chris Caparelli with Marquette Associates. Marquette's been our investment consulting firm now since 2019. And Chris is a managing partner for the firm, and he actually brings over 14 years of experience in the industry with a focus on nonprofits. So welcome, Chris, and we're glad to have you today. In addition, this year, we're also fortunate to have another Marquette associate, and that's Evan Frazier. He's from the research side of the house, so he'll be joining us as well. So Evan, thank you for joining us. And Chris will be doing the more formal introduction of Evan a little bit later in the presentation. Before we got started, we were just having some small talk how, drastically different things are and the normal rules don't apply in this environment. So like me, I'm sure all of you are very anxious to hear what Marquette has to say around strategy and insight, given the volatility we're seeing in the market today. So we certainly look forward to the presentation. And just a few quick housekeeping items. All attendees have audio and video turned off by default. We do ask if you have a question, you can just put that in the chat and we will do our absolute best to answer those at the end, of course, given time. So chat feature is there if you're having any troubles or want to ask questions. So with that, again, I thank you for joining us today. We're going to spend the next 50 minutes or so with Chris and Evan. And so Chris, I will turn it over to you to lead us through the presentation.
All right. Sounds good. Thank you very much, Carrie. It's nice to be with you guys all this morning and have a little chance to chat about the portfolio and markets. So I will cover some of the bigger picture stuff for the first maybe 10 or 15 minutes or so. Just give you a quick reminder of who we are at Marquette and kind of what we do, and how fortunate we've been to work with the Community Foundation over the last number of years. And then I'll turn it over to Evan. I think he's probably got the more interesting segments this morning, as he'll give us a little bit of an insight into kind of what we're seeing this year in markets, and hopefully a couple clues as to what to maybe expect for the future. Maybe not predictions, but a little bit more of a framework for things going forward. It has certainly been a pretty challenging year here in 2021. There are so many moving pieces in markets that have kind of been shifting around over the last couple of years. So it's definitely an interesting time to be doing the work that Evan and I are doing. And again, lucky enough to be doing it with you all here at the foundation. So just again, as Carrie mentioned, Chris Caparelli and Evan Frazier. I am a field consultant at Marquette, so I spend my time working with organizations like the Community Foundation and sort of designing the overall plan structure and executing the investment program. And then Evan is on our research side, specifically spends a lot of time in the U.S. equity markets, but also does sort of overall capital market work as well. So he spends a little bit more time on the market side of house, where I do maybe more of the portfolio construction. Just a quick look at who we are at Marquette. So, maybe not a household name in the overall industry if you're not sort of in the investment consulting space, as I imagine most of you aren't. We're a mid-size consulting firm. We work with about 450 different institutions, represents about 350 billion in assets under advisement, been around about 35 years or so. And you can see on the right-hand side of the slide, we've got a pretty sort of unique client breakdown that nonprofit organizations like the Community Foundation is probably the largest segment of our business. But we're also, fortunate enough to work with union pension funds, public pension funds, some corporate plans. And I think that sort of breadth of client type really helps us bring sort of solutions from the different types of groups and apply them across the entirety of our business. The nonprofit space is sort of the largest piece of our overall business, about 150 nonprofit clients. The median client size is around $100 million, and the average is about 300 or 350 million. So an organization like the Start Community Foundation is right in our wheelhouse at Marquette. And we're fortunate enough to work with some really phenomenal organizations with a couple logos over on the right-hand side of the page. And I think, one of the most important things for us is our independence. We work really just for each other at Marquette and for our clients. We're responsible to really no outside or no third party. So it allows us to provide the best investment advice that we can. It's not that we're always going to be right, but it's that at any point sort of in the cycle or any point in markets, the information and the advice that we provide our clients is sort of that best information that we have up front, and hopefully it's comforting to know there's really no conflicts of interest in our business, and all we're doing is providing advice and solutions to build customized portfolios for our clients. The fact that we work with so many nonprofit organizations, I think, really helps us sort of align our mission with those of our underlying client organizations. So here you see our sort of mission statement at Marquette, and the one is Start Community Foundation. I think they align pretty well. And what it allows us is to really understand that every dollar in the portfolio is incredibly important. Every dollar that we can help grow the portfolio or save fees is a dollar that can be plowed back into the community. And we take that responsibility, really seriously with the goal of, again, growing the pool of assets in a responsible way to hopefully help improve and increase the impact that the foundation can have, in the local community. As far as the work we do, if you kind of had to boil it down to 3 words, it's build high quality portfolios, manage risk, and keep a real close eye on costs. So as I mentioned before, again, every dollar in the portfolio that we don't have to pay to underlying investment managers is one that can be used to further the mission. So we spend a lot of time trying to build efficient portfolios, making sure there's very little overlap between segments of the portfolio, and then really, partnering with underlying investment managers that we feel really, really good about. Meanwhile, building an asset allocation and investment policy statement with an eye on really, kind of keeping risks under control in the portfolio, making sure that, again, not that we always know where things are going to go going forward, but just knowing that, sort of given a certain set of assumptions, making sure that we have a pretty good sense of maybe how portfolios or underlying managers will react given different market conditions to hopefully have not a whole lot of surprises going forward, because surprises in markets are usually to the negative side and not so much to the positive. So just spending a minute talking about overall portfolio construction. We are, I guess, maybe more of strategic investors than tactical or anything else. We are firm believers that overall portfolio asset allocation is really going to drive outcomes over the next 5, 10, 15, and longer term periods. Because the idea here is really investing for the long term, if not forever. So we don't want to spend a total lot of time talking about market timing or security selection. We think it's really that overall asset allocation. So if you think about the portfolio percentages between stocks and bonds being more important than maybe the individual securities that you're choosing within those particular pools, and that this helps us hopefully build a more sort of predictable portfolio and path going forward. The thing that has changed most dramatically in that asset allocation sort of puzzle is the interest rate environment. Interest rates this year in 2022 have risen fairly dramatically, and it has caused a lot of moving parts within the overall market and the overall economy, and has caused sort of a lot of areas of the market to sort of reprice and incorporate that information and sort of into those future assumptions. So just a quick slide here about the interest rate environment. Long term, going back to the 1960s, you can see kind of 1960s through kind of the early 80s, interest rates were rising dramatically and rising in a pretty steady pace, reaching a peak of about maybe 16% in the early 80s. And this is just the 10-year U.S. Treasury market. And really, since that point in time, for about 40 years now, we've been in a bull market for bonds. Interest rates went from 16% down to about 1.5% at the end of last year. That was about as low as they got. And then over the last sort of 9 months or so, rates have gone from 1.5% to about 4%. So overall, it's not that interest rates in the economy are all that high given history, and you can certainly see it on the chart. It's just that in this year, we've seen a sharp rise in a very short period of time, and that has caused a fair amount of dislocations in the market and has caused some changing returns and returns environments that Evan will talk a little bit more about in a minute. So as we think about, how do we use that information and incorporate that into the portfolio that we're building and the advice that we're giving to the Community Foundation and our other clients, we try to be, again, long-term investors. We try to think 5 and 10 years forward rather than 3 months forward or 6 months forward. So we have an asset allocation model, and that model helps us sort of predict or maybe try to anticipate where we think asset classes will be and returns will be going forward. So what you see here on this chart is just stock and bond markets and sort of projections for the next 10 years. If you were to look at those two markets about 10 years ago, back in 2011, when we were still in sort of the early stages of recovery from the financial crisis, that asset allocation model told us that stocks would probably earn over 10% over the next decade, and we think bonds were going to return about 4% over the next decade. So if you think about just those two asset classes, and there's certainly a lot others that we use when we build portfolios, but if we think about just the stock and the bond market overall, you combine that 10% from stocks and 4% from bonds, and you probably end up with a pretty decent return, somewhere around 7% or somewhere a little higher, depending on the overall mix. Now, over the last 10 years, as the economies, recovered from the financial crisis, and we went from 2010 to 2020, we had a really, really strong decade of returns, really across the board. And as a result, those future expectations started to notch down. So by about the end of last year, by the end of 2021, those forward return assumptions for stocks were probably about 6.5 or 7, and bonds were about 1.5 or 2. So it became a lot harder for institutional investors like the foundation and like ourselves to try to design a portfolio that was going to hit our overall sort of return assumptions at the total pool level. Now, what you see just on the very right-hand side of this chart is that those numbers, particularly on the bond side, have ticked up here dramatically in the last 9 months. So as interest rates went from 1.5 to 4, or on the Fed funds rate went from 0 to 3, it has caused a fair amount of pain in markets here in 22. But what it has done is made those sort of future returns and future assumptions look a little bit brighter. So maybe that's the silver lining that you can take away from today as we think about all that's gone on this year and the negative returns we see across a good chunk of the market, is that the future environment and for organizations like the foundation that are investing for 5, 10, 15, 20, 50 years, what we're going through right now actually makes things a little bit easier going forward to hopefully hit our sort of return assumptions. That return assumption in the case of the Community Foundation is 7.75%. That is our long-term objective. That's the goal that we're trying to achieve. And then all the little data points you see on the charts on this chart here are sort of the building blocks or those underlying pieces of the portfolio that we put together in that asset allocation to hopefully achieve that objective going forward at 775. So I'll just point out a couple things on the chart. If you look in the kind of lower left-hand corner, this blue dot right here is the U.S. investment grade bond market. So the benchmark there would be the bar cap aggregate. And that has a return assumption today for the next 10 years of 4%. And that's actually a pretty decent return. Again, if we rewind the clock back to only about a year ago, the 10-year forward assumption for that asset class was about 1.5%. And that made it difficult for institutional investors, for individuals, for retirees to sort of generate any kind of income without taking on an awful lot of risk in the portfolio. Because the return is one side of the equation, the risk is the other. And historically, the bond market usually plots on the left-hand side, meaning it maybe doesn't offer a whole lot of return, but it also doesn't have a lot of risk. Whereas you see equities, kind of out here on the right-hand side that generate more return, but have a high risk component. So it's sort of balancing those two pieces, putting all these, various asset classes together, public markets, private markets, and then again, generating that hopefully long-term rate of return assumption of 7.75% that should keep the portfolio growing in real terms, so keeping sort of ahead of inflation and allowing the portfolio to spend off a decent amount of cash flow, again, to sort of plow that back and put that in the community and impact, the parts of the foundation that we're looking to achieve. As far as what is the specific asset allocation that the foundation has looked like, and maybe how has that changed over the last number of years. The pie charts here represent maybe what the portfolio looked like 3 years ago, and then what it looked like kind of in the middle of the summer this year. And a couple things you'll notice under sort of Marquette's guidance and under our recommendations is that we've tried to take a little bit of the risk out of the portfolio. So maybe using a little less public equity markets, both in the U.S. and outside the U.S. And the trade-off there has been, if we're going to have a little bit less equity that we know is high returning but high risk, where do we look to put those assets? And the answer for us really over the last few years has been the private markets, real estate, infrastructure, private equity, and private debt. Those asset classes have a fairly high return assumption. They also tend not to have as much volatility as other parts of the market. But the trade-off there, and that there's always trade-offs in markets, and that they have less liquidity. So that's sort of the trade we've made over the last number of years, is have a little less liquidity in the portfolio to hopefully achieve that higher return assumption with an overall lower level of risk. If you were to ask me where I think this pie chart is going to be a few years from now, I think we're likely going to see this core fixed income section that's only 8% grow. And the reason for it is those higher interest rates. We think we can probably achieve the same level of return in portfolios going forward with less risk, more bond market exposure. And that's really sort of the result or the impact of what we've seen here in 2022 from that higher interest rate environment. So we use the investment policy statement as sort of the overarching guiding document for the portfolio. I think this does a great job of keeping us honest and keeping us on the same page with the committee and the board as we go forward, and as markets get volatile, like a year like this year. This target asset allocation column is probably the most important piece in the overall investment policy. And it says, hey, here is what the long-term plan looks like for the portfolio. And as markets start dropping, and things like the S&P 500 are down 25% this year, it's this policy that we rebalance to, and this is our long-term target and our plan. So not to say that this never changes, because it does, but if we do our job right, this shouldn't be something that's changing on a 3 or a 6 month basis. It's something we look at annually and something we update probably every couple of years, because markets do change and we incorporate new information. But this is really, when we're going through volatile periods like 2022, it's the investment policy statement that sort of, keeps us all on the same page and working towards that long-term goal. So the first, probably most important part of the process for us is setting that asset allocation, setting those target allocations in the investment policy statement. But once we have that asset allocation set and we have sort of all the asset class buckets agreed upon, the next phase of the process, and this is where Evans and his team really come into play, is finding high quality investment managers that we feel comfortable with going out and actually investing the dollars, picking the individual stocks and bonds in the portfolio. For us, there's really no silver bullet to identify good, high quality investment managers. It just takes an awful lot of meetings. Our team does about 10 meetings per day, per business day, meeting with various investment managers across the entire asset class spectrum. And I think one of the things here you'll notice in this chart, and this is what's changed for us over the last 10 years, a lot of those meetings, or a good chunk of those meetings, are happening in the private markets. We're spending sort of less time as a team in maybe public equities and public fixed income, and more time in things like real estate, private equity, infrastructure, as those asset classes are a little bit more opaque. And it's probably more important in those areas where there is more illiquidity to find managers that we really feel comfortable and confident in to invest our client capital. Just a couple names or a couple logos here of what some of those underlying managers look like in the Community Foundation portfolio. This is just sort of a random smattering of names that we use to go out and invest the securities. One thing you'll notice here, there's probably a couple names that are familiar to you all. Maybe a local group in town, a Beast Fulmer there in the middle of the page. Then there's also some, conglomerate asset managers, a group like BlackRock, a group like JP Morgan Asset Management, that is, these massive sort of household conglomerates across the space. But if we're doing our job right, there's probably a few names on here that you guys don't recognize. And I think that means we're, again, going out and finding sort of boutique asset managers, specialists in their space that really can execute on one sort of given mandate in the portfolio. So a group like Parametric down on the left-hand corner, probably not a household name. They run some option strategies in the portfolio, or maybe an ABS Global Investments that does emerging market equity investing. And again, that's what that sort of underlying manager diversity should look like. Some local groups, some boutique non-household names, and then probably, a couple conglomerates in there as well. And we put those all together and get the sort of overall portfolio structure. So the last couple of things I want to talk about is performance. Obviously it has been a very challenging year here in 2022. If we look at the bar charts here down on the kind of left side part of the page, on a year-to-date basis, the Stark Community Foundation portfolio is down almost 15%, 14.8%. That's a pretty tough number. There's no way around it. Never fun to see that type of decline. And I think, one of the most sort of eye-opening things here is what I kind of included here in the gray box. So as I was preparing for this, I was looking at sort of what we had done last year. And the slide here in the kind of lower right-hand corner is what those returns looked like last year at this time. It's a little hard to see, but over the 1-year period, last year, the portfolio was up 25%. So it was a phenomenal period, sort of same time last year, backward looking, and a lot has changed here in 2022 to create this negative return environment. The good news here, there's a couple kind of positive takeaways. One, the foundation has pretty consistently been able to outperform its internal benchmark, sort of the policy that we are beholden ourselves to and our long-term objective. And then if you look at the right-hand side of the page, even given this very sharp return here year to date, it's still been a pretty strong 5, 7, and 10-year period. We are long-term investors going forward, and we think it makes sense to look at the sort of long-term trailing returns backward to give a sense of sort of, maybe not getting too overly worried about or invested in sort of that short-term time frame and that short-term return period. Another thing I think is a pretty good takeaway so far this year is that despite the 15% decline and 14.8% year to date, the Stark Community Foundation's done a pretty good job of being a little bit ahead of the peer group and maybe protecting capital a little bit better than sort of the average endowment and foundation or nonprofit organization around the country. And you see pretty consistent returns a little bit ahead of the peer group. So again, while it's never fun to be down 15% and it's definitely a tough environment, there's a couple good takeaways here. And one is that we've been able to protect capital a little bit better than maybe the average institution across the country this year. And then the last thing I wanted to share is just maybe how the portfolio looks like compared to that peer group. So if we look at performance versus the peer group, it's maybe interesting to see how that peer group or other endowments and foundations around the country are invested. Overall, fairly similarly invested compared to maybe how others invest. We don't generally recommend sort of massive asset class differences versus others, as there are certainly some wisdom in crowds. But again, if you look at this chart here, we probably have a little less equity than the average organization around the country, and probably a little bit of an overweighting to things like real assets and private markets, real estate, infrastructure, private equity. And that's really what's been most helpful in the portfolio this year in keeping those numbers maybe a little bit better than where they otherwise would be if they were invested in just the stock and bond markets. So I'll stop there. The next section, I'll hand it over to Evan. And Evan will talk a little bit more about the overall capital markets and some asset classes, give you a little sense of maybe where we've been this year and a couple things and some thoughts about where we may go going forward. So Evan, the floor is yours.
Awesome. Well, thank you, Chris, and thank you everyone for joining us today. Certainly appreciate it. We've got a lot to cover here and not a ton of time, so we're definitely going to hit the high notes. But if anyone has any questions, feel free to drop those in the chat or just follow up with us after the meeting. So, Chris, if you want to go to the first slide here. Yep. So as all of you are no doubt aware, and as Chris alluded to earlier, 2022 has been a difficult year for almost every major asset class, given a lot of these macroeconomic headwinds that Chris detailed: higher inflation, interest rate increases, a war in Europe, certainly. You can see here on the chart the two lone positives from an asset class perspective on a year-to-date basis are commodities and real estate. Those are two asset classes that typically benefit during inflationary environments and periods of rising interest rates. But it's a very different story throughout the rest of the market. Domestic stocks are down close to 25%. This is the worst three-quarter start to a year for the S&P in over 2 decades. And it's even worse on the international equity side due to the impact of currency movements that we'll detail later in the presentation. And then Chris also mentioned the fact that fixed income has just gotten crushed this year due to rising rates. The Barclays Agg has its worst start to the year ever this year. So there's really been nowhere to hide. And again, a big reason as to why this has been the case is sort of the macroeconomic environment, which we'll detail in the next couple slides. So as all of you are no doubt aware, inflation is high. As measured by the CPI, it's the highest it's been in a generation. So you have to go back to the 1980s to find a time where headline CPI was this high. It actually ticked down in September, but still sits at about 8.2%. And then core CPI, which excludes food and energy prices, is also elevated relative to where it typically is. It's around 6.6%. And this has led to the Federal Reserve coming down very, very hard in terms of monetary tightening, those interest rate increases that we'll detail in an upcoming slide here. So yeah, in response to this elevated inflation, the Fed has been raising interest rates since the beginning of the year in order to combat elevated price levels. This is sort of the primary tool that the Fed has at its disposal to combat inflation. So Chris mentioned this earlier, but the effective Fed funds rate at the beginning of the year was around 0% and had been for quite some time. That number is up to 3% thereabouts at present. And as you can see here, more interest rates are expected by the market through the rest of this year and into 2023. Now you can see as we get deeper into 2023, the market does expect the Fed to be a little bit more accommodative, maybe a little bit more lenient, potentially cutting rates to encourage growth should economic conditions sour. And you can see here that the Fed actions have, I would say, maybe assuaged investor concerns a little bit in terms of the long-term trajectory of inflation. So here we're looking at the 5- and 10-year break-even inflation rates, basically an indication of where the market, where investors think inflation is going to wind up over those respective periods. And you can see that both the 5- and 10-year break-evens have dropped pretty precipitously since the start of the year, down to a little over 2%, which is typically where the Fed kind of wants to see inflation as of the end of September. And this is an indication that at least the market expects the Fed to kind of be able to get a handle on elevated price levels in the near future if they continue on this interest rate hiking trajectory. And I would say, despite some of the challenges posed by inflation and the prevailing kind of macroeconomic sentiment, the labor market remains strong to date. So the U.S. economy has added over 250,000 jobs in each month this year. And the unemployment rate currently sits below 4% in this country. And this is important because when we think about what the Fed will be doing in the coming months, you know, the Fed has a dual mandate, right? They're responsible for maintaining reasonable price levels as well as controlling the unemployment rate. So those are the two things the Fed's going to be looking at. And I think, you know, as long as unemployment remains low, they're going to be able to be aggressive in terms of bringing down inflation and hiking those interest rates. So, you know, when we think about what they're going to be doing in the near term, as long as unemployment's low, I think it's fair to say that they're going to have their foot on the gas in terms of rate hikes going forward. And if you want to go to the next slide, Chris. Yep. So this is kind of where the rubber meets the road in terms of, you know, whether or not we're in a recession. I'm sure, you know, different people have different opinions because there's actually not one sort of objective measurement in terms of what constitutes a recession. One common measure that we kind of look at is 2 consecutive quarters of negative GDP growth in this country. And if we go by that measure, we're already here, right? We're already in a recession in the United States. We've seen that the last couple quarters. But, you know, like I said, it really doesn't feel like a real recession based on a variety of different metrics, one of which I mentioned is unemployment. Unemployment below 4% doesn't really feel like a recession. Another one is consumer spending, which, as you can see here on the slide, accounts for about 70% of the gross domestic product in this country. And that's not only positive, but it actually accelerated in the second quarter. So we haven't gotten 3Q numbers yet, but the reality is the consumer remains strong. And I suppose time will tell if that trend persists into the future. So that's kind of the economic backdrop. Let's get into the weeds a little bit on kind of performance of various asset classes, and we'll start with fixed income. We mentioned earlier that you know, the Barclays Ag has had its worst start to the year this year. On a year-to-date basis through the end of last month, it's down about 15% amid this backdrop of rising rates. Obviously, when rates go up, bond prices go down, all else equal. But again, as Chris mentioned earlier, the good news is that with rates a little higher now, I heard a joke that fixed income finally has its last name back, and that is income. So bonds are now kind of acting like bonds, which is good, and we should be seeing more attractive yields out of the space going forward. As far as the current state of the Treasury curve, yields have come up across all tenors in the last several months. You can see sort of the top half of this page here. Fed actions have pushed the shorter end rates a little higher. But we're now seeing a 10-year yield of just under 4% as well for the first time in years. And what's more, we're actually seeing an inversion of the yield curve along the 2 and 10-year yields, where the 2-year is actually above the 10-year. You can see that both in the top part of this chart as well as the bottom. And I mentioned this because this type of inversion, the inversion of the 2 and 10 spread, typically predates a recession in the U.S. by anywhere from, call it 6 to 18 months. So this is definitely sort of I would say a warning signal for us, and something that we're watching very closely, sort of the shape of this curve going forward. So that's kind of high level on the fixed income market. Maybe let's get into the equity side here. We'll start on the U.S. side. So no secret, domestic equity indices are down this year. It's been a very, very painful year, certainly on the U.S. side. I think a lot of what's been driving this, at least from a sector perspective, and Chris, we can maybe go to the next slide here for sectors. Yep. So as you would expect, the more growth-oriented sectors of the U.S. equity market have been hit the hardest as rates go up. I talked about bond prices going down, but longer duration, growth-oriented spaces of equity markets go down as well. So you can see here communication services, information technology, consumer discretionary. Those spaces are all down 20-30% this year amid this backdrop of rising rates, as well as maybe some concerns about the growth prospects of a lot of companies in this space. We've seen the multiples, and we'll detail this in a later slide, but we've seen the multiples, the valuations on a lot of these spaces come down in recent months, and that has seriously negatively impacted those spaces that exhibited high valuations going into this year. Maybe one bright spot I'll point out here, and you can probably see sort of an outlier, is the energy space. So it's a smaller segment of the U.S. equity market, but you can see that it's up about, call it 30% on a year-to-date basis through the end of last month. And, energy, sort of like commodities, very, very sensitive to kind of the macroeconomic landscape. And when inflation is high, and, when you've got geopolitical issues as well, that's a space that tends to see stronger earnings growth. And that kind of accounts for the strong performance for that space on a year-to-date basis. Another thing we like to look at is factor performance, or the performance of different styles during various time periods. And you can see here returns for, say, value, growth, quality on both a monthly, quarterly, and year-to-date basis. And I think the thing I would point out here is, and I mentioned this before, it's been a tough year for growth. I mean, growth has really been strong, really for the last decade or so, amid this low rate environment. Certainly when COVID came onto the scene, we had lockdowns, stay-at-home orders. Interest rates went to zero. All of that was sort of very conducive to stronger performance of growth, maybe to the detriment of value. But we've really seen that phenomenon kind of turn around this year. Interest rates have gone up. That's been accretive to value names. Again, maybe not on an absolute basis, because like I said, everything is down on a year-to-date basis this year. But relative to the broad market, value has had a strong year. Low volatility equities, those more defensive stocks, utilities, consumer staples have held up relatively well. And then dividend payers as well have performed strongly. One thing I would maybe point out on this chart, and we'll see this too, I think, on the non-US side, is maybe the lackluster performance of the quality factor. This is something that we've been looking at pretty closely, because you would think that when markets draw down, higher quality names might protect a little better to the downside. That has not been the case this year, and I think there are a couple reasons why that hasn't been the case. Number one, again, a focus on the macroeconomic environment. Those energy companies, those cyclicals that have done very well, are typically of lower quality from a balance sheet perspective. And quality names were very, very expensive going into the year. And again, a lot of the negative performance that we've seen hasn't necessarily come via deterioration of company fundamentals, but rather just a repricing of assets across the board and a compression of valuation multiples. And so we've seen the multiples on a lot of higher quality companies come down in the last several months. And this is sort of speaks to that point a little bit here. So if you quintile out the U.S. equity market, if you divide it into 5 different buckets based on valuation, so you can see PE quintile 1, those are the most expensive stocks in the market. Those are the ones that have really, really gotten hit hard. So the most expensive 20% of stocks in the S&P 500 are down over 35% this year, again, amid those rising rate, that rising rate environment. And again, everything is down, but the cheaper stocks in those 4 and 5 quintiles have held up relatively well versus the broad market. So what does all of this mean in terms of valuation? So again, maybe some good news to take away from all of this is the fact that valuations have come down, and that means that entry points now are a little bit more attractive. So if we look, I'll just mention the S&P. It's not listed on here, but that's sort of a general benchmark that we look at in terms of the domestic equity market. That trades right now at about 15 or 16 times forward earnings. That's right around its 10-year average. And again, we went into this year, we've seen these exorbitant valuations, very, very elevated relative to history. Those have certainly come down in recent time. And you can see here, I'll call out the Russell 2000 Value Index. That tracks small cap, cyclical, small cap value stocks here in the US. From a price to earnings perspective, both trailing and forward PE, that index is currently the cheapest it's been since we've started tracking this metric in the last 20 years. So, again, there's been a lot of pain, there's been a lot of re-rating, but certainly certain aspects of the U.S. equity market, certain areas of the market are more attractive from a valuation perspective now versus 9 months ago. So let's maybe we're going to stick on the equity side, but we'll turn to kind of the global and non-US space. And so it's a very similar story here. The third quarter is the third consecutive negative quarter for international equity markets. So the ACWI ex-US index, which is an index that kind of tracks broad, both developed and emerging markets, was down roughly 10% during the third quarter, bringing the year-to-date return for that benchmark to about negative 27% through the end of last month. And as you can see from this table, both large and small cap developed markets stocks held up better than emerging markets during the period. However, the impact of currency movements continue to be more impactful on the returns of DM equities versus their EM counterparts. And again, we'll talk more about currency and kind of why that's important later on in the presentation. So yeah, as the subtitle says here, there hasn't been a whole lot of places to hide, at least from a country perspective this year. Things have been kind of painful across the board. Maybe start in Europe real quick. I think it's safe to say that the Eurozone and UK economies are either in or close to a recession at this point. Germany has been a main laggard on a year-to-date basis. Stocks in that country are down nearly 40% since the start of the year, and we're down 15% in Q3 amid declining business activity and high inflation, as well as those increased energy costs that I talked about earlier, and those are a headwind for German equities in particular. If you look at the UK, obviously there's been a lot of turmoil on the political front within the United Kingdom. Those stocks were down about 12% during the third quarter amid, again, maybe some fiscal policy missteps of the now old government that required some intervention by the Bank of England. I don't know if we have a slide on China in this deck. I can maybe talk about China very quickly because that's another important topic. So China was actually the worst returning country during the third quarter, at least on this list. Chinese equities were down around 23% during Q3, which brought their year-to-date return to about negative 30%. And this is due to a variety of factors. So the economy is slowing in China. It slowed to about 2.7% growth for the current year after growing, I think, at about 8%. Last year, they've been very restrictive on the COVID front. That zero COVID policy has really been negatively impactful to the economy, and they've also been battling some issues in their property market. And even in recent days, you've seen sharp sell-offs in Chinese stocks after their party congress, during which their leader Xi won a third term as party leader and sort of further consolidated his power. And I think a lot of that has kind of led investors to believe that China might be challenged in the future due to geopolitical issues and maybe some economic tensions with the West. So certainly an area of the market that we're watching very, very closely. So yeah, I talked about currencies being a significant issue on the non-US side in terms of return. So if you look at returns sort of in local terms for non-US equities, things haven't been that bad, but we have to take into account the impact of currency because as US investors, when we go to translate the returns of local companies into the US dollar, we have to take into account the currency movements. We've talked about Fed rate hikes earlier in the presentation. These hikes have caused pretty significant waves in international currency markets. The dollar is at a multi-decade high right now against major international currencies. And when central banks are restrictive, like the Fed has been, the currency typically gets stronger. So with interest rates rapidly rising here in the US and investors kind of more broadly worried about a global economic slowdown, a lot of investors have kind of moved into the US dollar in search of yield and kind of a safe haven investment. So the dollar rose about 8.5% during the quarter, while currencies like, the euro fell about 7%, the yen fell about 15%. And this, like I said, because of the translation effect, this is important for investors here in the US, and has really accounted for over half of the negative return that we're seeing both in developed and emerging market equities right now. So again, this is going to sound similar to what I just talked about on the US side, but if there's a bright spot in all of this mess, it is sort of how valuations kind of look within the international equity market right now. If you look at forward PE ratios for developed market indices, so like EFA and EFA small cap, those multiples currently sit within the cheapest quintile for their respective benchmarks in the last couple decades. And things are also cheap within emerging markets. So on a forward PE basis, the MSCI Emerging Markets Index currently sits within, I would say, close to the cheapest third of its history, and is even cheaper if you look at other metrics like price to book and price to sales, again, relative to where things have been for that index over the last couple decades. So international stocks are cheap relative to their own histories, but they're also cheap relative to US stocks. So we do have the S&P 500 listed here. I mentioned it's seen its multiple come in recent time. The forward PE, like I said, is right around 15 right now. That's around its long-term average, but that's compared to multiples of what, 10.7% for the EFA, 10.2 for the EM index, and then 10.8 for EFA small cap. So again, international stocks, cheap relative to their own histories and cheap relative to domestic equities here in the US. So we're going to talk a little bit about alts and private markets. These asset classes report performance with a lag, so we don't have 3Q performance information, but we're going to talk kind of high level about what we're seeing in private markets and how certain private markets asset classes might react to the environments that we find ourselves in right now from a rates perspective, inflation perspective, et cetera. So we've talked about rates going up and the ability of bonds to now generate solid income streams. I think the same is true for real estate and certainly infrastructure. So on the core real estate side, I'd say one thing to be positive about is returns of this asset class during rising rates environments. That's not aberrational. So core real estate tends to perform very well when the Fed tightens, dating back to the late 1970s when rates go up. The space averages an annualized return of about 13%. So as long as rates continue to rise, this space, might be able to provide some attractive near-term opportunities. And then infrastructure. So again, I talked about more attractive yields on the bond side. Infrastructure investments have typically been able to grow their EBITDA over the last decade plus at an attractive rate, and that's allowed them to kick off a robust dividend yield to investors well in excess of that of public equity indices. Here we have the S&P listed in the blue. So, we like real estate and infrastructure due to their ability to weather different rate regimes, as well as their status as sort of a viable source of income for investors, assuming that, folks like yourselves can tolerate the illiquidity that kind of comes along with real estate and infrastructure investing. Let's jump to the private equity side. Again, still largely waiting on 3Q performance numbers, but the reality is this is a space that continues to provide very attractive returns relative to those gained in public markets. Again, if you can tolerate the illiquidity and maybe some higher fees that come with it. If you look here, we don't have any numbers here that you can see, but the median manager in the space represented by that sort of purple circle there within the bars has been able to provide an IRR or internal rate of return in excess of 10% in each year dating back to 2006, with more attractive returns coming in the last few years. And I think another attractive aspect of this space, if you want to go to the next slide, Chris, is sort of the extent to which private equity markets are more, I would say, insulated from public equities. I talked about the multiple on a lot of public equity indices coming down pretty significantly in recent times. We haven't necessarily seen that within PE. So if you focus on just middle market private equity firms, which is kind of the space that we tend to operate in, I would say the most, and we look at enterprise value to EBITDA multiples, they've been pretty consistent over the last decade plus, right around 9 to 12 times in the last 10 years. And, if you compare that to the Russell 3000 index, which is sort of a broad measure of the overall US equity market, so large, mid, and small cap equities, that had a multiple of around 20% less than 2 years ago, but has seen its valuation come in pretty significantly. Now it's around 12, 13 times at the end of last month. And again, I just think this is compelling to see that sort of insulation from public markets and speculation as well. The fact that these private market securities typically trade more according to underlying company fundamentals versus like the rate environment and what folks are kind of speculating on at any given time. So just thought this was interesting to point out. And the last thing on private equity is just sort of the amount of dry powder these firms have on hand. I'm sure you guys have heard a little bit about this. This has been kind of due to the slowing deal-making activity, I would say, amid this volatility that we've seen all of this year and the uncertainty that stems from that. So right now, I think there's over $1 trillion in dry powder throughout the entire private equity space, about $400 billion of which is in the middle market space, again, that we focus on primarily. So, while the deal-making landscape might be a little bit more challenged going forward, certainly GPs definitely have the capital on hand to execute on deals should those opportunities arise. All right, last but not least, from an asset class perspective, is private debt. Chris talked about this earlier, but certainly an attractive space that we like due to its robust performance during various rate hike regimes. So in the last 4 periods during which the 10-year rose significantly, private debt has returned at least 5% compared to IG bonds, which are typically negative. Some of this, I would say a lot of this has to do with sort of the floating rate component and floating rate nature of a lot of these private debt securities, which adjust their coupons along with some reference rate. So if the reference rate's going up like it is now, those coupons will adjust accordingly. So returns are strong in this space, and the asset class also offered as attractive yields and robust downside protection as well relative to public bond markets, certainly. All right, so that was a lot. Maybe we'll just kind of summarize our thinking now in terms of the go forward. So, on the fixed income side, it's definitely been painful the last 9 months or so, but we're happy now with maybe the yield that these securities currently offer. And I think as far as a buffer within portfolios, given kind of the turmoil that we've seen in recent months and potentially going forward, certainly an asset class that we like. On the equity side, I think more pain and more volatility is likely. At least on the U.S. side, as the Fed continues to combat inflation and hikes interest rates, the market's going to have to figure out how to respond to that. And even today, I think futures were down over a percentage point. We saw the market kind of bounce yesterday, so we're I think investors are going to have to figure out exactly where to land here. And so in the next 3 to 6 months, expect some more volatility, certainly within the growth space as well. Those longer duration assets maybe a little harder to price given where rates are going. On the non-US side, similar story there too. Again, just maybe highlight the currency aspect of it. The dollar will revert at some point. There's no doubt about that. And that should be a tailwind for non-US equity performance as well as the performance of those international currencies. But, in the near term, as I said, the Fed's gonna stay aggressive. That should keep the dollar strong. So I frankly don't expect the international currencies to revert within the next 3 to 6 months. So definitely some headwinds there for non-US stocks. Talked about real estate, higher interest rates, inflation, maybe not the best for that space, but maybe relative to some other areas of the market, not the worst place to be if you can tolerate the illiquidity. Hedge funds is a space that we didn't really talk about that much today, but I think there's some attractiveness within that space. So hedge funds generally have held up relatively well this year. I think the HFRI fund of funds composite index is only down about 4% this year. Hedge funds typically serve as a nice buffer. And as we get into a period of more rate normalization, there's a cost of capital in the markets now that should be good for good stock pickers as well as long short equity strategy. So hedge funds might be a space that see some tailwinds going forward. And then private equity, private credit. I suppose time will tell there. The lockups there are pretty significant, but I talked about kind of the floating rate nature of a lot of private debt securities. That's certainly an attractive place to be given where rates are going and have been. And then private equity, I think we talked about those securities trading a little bit more according to company fundamentals. As long as fundamentals stay strong and they have to this point, I think it's safe to say that private equity, might offer some more muted returns relative to its own history, but no reason to expect, cataclysmic events in the private equity space, given where we are from a macroeconomic perspective. So, Chris, maybe I'll turn it back over to you if you have any other thoughts on any of these asset classes or, the prevailing sentiment within markets right now.
No, thanks, Evan. That was really good. Look, like we said a couple of times, it's definitely been a pretty challenging year. It's important to take history into context. We've had 3 really strong calendar years before that, even with what went on when COVID with that sharp downturn at the beginning of 2020. 2019, 2020, 2021, all really strong years for risk assets, probably record years in some cases. So it is certainly natural for markets to pull back. We wish things went up in a straight line, but they don't. And that's what we're in the middle of today. So I think it's probably more important during this environment to sort of re-examine all the parts of the portfolio and make sure we have the right structure going forward. But as we said a couple of times, certainly in the bond market, it's easy to figure out. If you can buy a 10-year treasury at 4% today, that's a much better coupon than you got a year ago. So that return increases. And then even on the equity side of things, while things maybe don't look cheap in the US, it's not like a screaming value or a screaming buy like it might be on the international space. Things are certainly a lot cheaper than they were at the beginning of the year. So as long as the holding period is 3, 5, 7, 10, 12 years, buying equities today is a better valuation proposition than it was a year ago. So, not to say that there can't be more downward pressure or more volatility over the next 6 to 9 months, because there probably will be. But generally, if you look back through history, when the stock market's down 25%, that's usually not a bad entry point as long as your holding period's long enough. So I'll leave it there. That's about all we had wanted to share. Thank you again for your time. And, Carrie, maybe you got a couple questions before we sign off.
Yes, thank you. First, outstanding job, both of you, and thank you. And it is nice, there's a couple bright spots like you talked about, and we focus so much at the foundation on the diversification of our portfolio. And I know, Chris, you went through that asset allocation, but it's kind of nice to know during times like this that we can lean on some of those more or less traditional asset classes to hold us up a bit. So definitely some bright spots there, but just a couple questions around the Feds, because there's so much scrutiny right now around their actions. And I mean, there's some thoughts that maybe they were a little bit late to the dance in terms of the rate increases. But what's your thoughts now? Are they going too quickly, too much, too fast? Is that a concern, or do you feel, they're doing what they should be doing?
Yeah. So I think, I think back to my, one of my college economic classes, and I still remember it from, how many years ago it was. But, the professor had said it takes about a year, if you look through history, for changes to the Fed funds rate and any sort of policy changes to really impact the economy. And if you think about it, we have not yet lapped a year on their first interest rate hike. So we've not yet even gone a year, and they've raised rates significantly in that time frame. So it's certainly possible that they've maybe been a little too aggressive after being a little sort of slow to react last summer when we saw inflationary pressures building. It seems like the markets have priced in another 75 basis point hike here in the next couple of weeks, and then perhaps another one even before the end of the year. So you could have a Fed funds rate that's in that 4.5% to almost 5% range before year end, and that is a massive change from where we were last year. So it is certainly possible that they've gone a little too far. Now, they've remained committed to getting inflation under control and have really resisted any temptation to even talk about pulling back on those rate hikes. But it's possible that the market may, maybe force them to. If we start to see the data roll over, you start to see the unemployment picture change early next year, and we see, further downward pressure in securities markets, it's likely that we're maybe nearing the end of this rate rise environment.
Okay, thank you. And I guess sticking on that topic of the Feds, we hear the Feds have two jobs, and that's to keep prices and unemployment in check. But we also heard Evan talk about, the impact their rate hikes have on, international currency. Do they ever give consideration to that? Because I know there's a lot of talks about these rate hikes causing a global recession. Do they give any credence to that, or is it strictly domestic? We're focusing on America and we're not worrying about all of that.
Yeah, and that's where I think things have changed over the years, and that's where despite the fact that the Fed is supposed to be completely independent, it's especially in election years, it's hard to think that there isn't some pressure coming from Washington, perhaps. So as far as their listed mandate, they are focused on the U.S. market, the labor market, and price stability. Today, with the interconnectedness of global markets, it's impossible to ignore the impacts you have on other places. So I'm sure they use that as a data point. I'm sure they're aware of it. Again, they probably can't say that in the way that maybe markets might like them to say for political reasons. But you can't ignore that part. And it's definitely had an impact on the rest of the world and certainly the emerging market economies. Now, that has changed a little bit. If you look back at past rate cycles in the 90s or maybe the late 90s, emerging market economies were much more susceptible to what we did here in the U.S. Over the last 20 years, as they've sort of emerged, for lack of a better word, although some countries like Russia have gone the other way, they've gotten their fiscal houses in better shape and are maybe a little less sensitive to what's going on in the U.S. So I think by and large, the emerging market economy, which would be the most sensitive to this, is holding up better this year than they have in past cycles. But they certainly have to pay attention to it. And I think this Fed, led by Jerome Powell, is more aware or more openly aware to what markets are doing than maybe his past predecessors. A guy like Greenspan would have told you or would have told the markets that he doesn't pay attention to what the stock market or the bond market's doing, but these guys do, and that's something that's changed over the last 20 years. They're more aware of what's going on in the markets.
And you saw that in 2018, right? Obviously, it was a different situation, but the Fed started getting a little bit more aggressive at the back half of 2018. And the markets really went off a cliff, and then they were forced to backtrack and pivot a little bit. So to Chris's point, again, times have changed. Inflation wasn't at 8% and above in late 2018, but it's certainly something that they're maybe, like you said, more cognizant of now than under previous Fed chairs.
Yeah, and if you look at like the futures markets that sort of anticipate what the Fed is doing and how they're going to price things going forward, generally speaking, when you're about 2 weeks out from a Fed meeting, whatever the market has priced in almost always happens, because it's rare that they deliver a significant surprise. And at the moment, the market has another 75 basis point rate hike priced in. So the Fed's going to take it because the market's sort of already given them that leeway. So there's a very interesting interconnectedness between the market and the central bank, despite the fact that, functionally, they're not really supposed to pay attention to that. But there's no way around it at this point.
It looks like we're coming up on 10 o'clock, but maybe just one last question, and I guess without getting too political, any thoughts on the midterm elections and the impact on the market? Are we going to see that outperformance that might be traditional after that, or what's your expectations?
Evan, you have any thoughts on that one? I know we put some slides together in the past on like who wins and how that impacts markets. I think so many things have changed, and the parties maybe aren't what they used to be. And because historically, when you saw maybe a red wave or you saw Republicans take more of Congress, that was usually a good thing for the markets. But I don't know that the parties have sort of stuck to their historical leanings. I don't know that I've got a great thought on that, other than it probably causes volatility. I don't know if, Evan, you've got something else.
Yeah, I would say, markets like certainty. That's just sort of a fact. And so once we get resolution, whether it's, a red wave or a blue wave, I think that kind of certainty will at least give investors, more clarity into maybe what's down the road. I have a chart in front of me here. We put it together, sort of performance of equities, the S&P at least, during various years. So the 4 different years: midterm year, year after midterm, presidential election year, and then year after presidential election. And interestingly enough, the midterm year is the year during which the S&P typically averages a return that's the lowest, right around, call it 3 to 4%. But the year after the midterm is the highest. which is about 12%. So again, that's one data point. There's a lot of stuff going on here, but again, I think more clarity for markets is pretty much always a good thing. But I suppose time will tell, just because there's so many other factors at play right now that frankly are a little bit more important, I would say, than the midterms. The macroeconomic environment, the trajectory of interest rates, the trajectory of inflation, corporate earnings. I would say that those are certainly more impactful when it comes to the drivers of longer and near term, certainly equity market performance versus, who wins the House or the Senate.
Very good. Well, Chris and Evan, thank you again.